One of the men who've been sounding the warning signal on Lehman, not just for days and weeks, but for months, is David Einhorn of Greenlight Capital. He joins us on the phone right now. David, it's only been a few days since you were with us on set talking about this very issue, saying that they were going to need to raise money, that they didn't understand the losses on their books. And now it appears that to a degree you were right. Are you saying I told you so this morning?
Well, it does seem that a lot of the things that I've raised over the last while seem to have been borne out with this morning's news.
What, $6 billion, is that enough?
Well, it's hard to say. I mean, first you have to back up and realize that Lehman is raising capital that it said it didn't need. And it's not doing this for confidence, as they've said. And they're not doing it to get the shorts, as they've said. And they're not doing it to respond to unfounded rumors. They're doing it to replace losses that it previously said that it didn't have. So then the question is it enough, or did they get all of the losses? And I think for that we're going to need partly more details on the call, and in the upcoming SEC filings, the information isn't always clear. There's a few things that you can see from the press release this morning that already suggest that they didn't really take the full amount of the magnitude of the hit. For example, I'm looking at the line about the commercial mortgage-related positions, which is a very large area. It includes the SunCal investment, which, as I mentioned on the show, is undeveloped land in the Inland Empire of California. That's a 30-something billion dollar portfolio, probably even after they reduced it, and they only took a $700 million gross loss, or about 2 points on that entire portfolio. So I think this is a step in the right direction for them in terms of fessing up to some of the losses that I think have been obvious on the balance sheet for several quarters now, but it's not yet clear to me that they have more. But maybe they'll have better answers for this as they get onto the conference call and have a disclosure.
So stay short, or are you covering?
Well, right now we'll listen to the conference call. I wouldn't be expecting to do much before that.
But after that, they may convince you that they've done enough for you to cover your shorts, David?
Well, we could cover it, we could keep it, we could add to it. And it will all depend upon what it is that they say, how persuasive it is, what other information and details come, and what our assessment is once we have that additional information.
What would they have to say, David, to convince you that, okay, I'm going to pull off my shorts?
Well, I think if we got to the feeling that they really had been fulsome in acknowledging the extent of the losses, particularly in the commercial mortgage-backed securities portfolio, but also in the other areas, then I would think that it would make sense at that point to focus on something else.
David, Andrew Sorkin here. Stock's not even now off $2 in the pre-market. You know, you look at a statement like this come out this morning. Would have you expected it to take a larger hit? And really, where do you see the stock generally? I mean, $2, not that much. People are taking this in some respects as good news.
You know, it's hard to see that the stock being down $2 is a message of good news. That being said, you know, we tend to be pretty patient investors, and we tend to have a long horizon. I first spoke out about Lehman in November. I would think the stock was about 60 at the time, and incidentally, there was no reaction to the stock when I gave that particular speech.
That must have felt good.
Well, you know, it just kind of is what it is.
Right. I
just kind of look at it that I tend not to get overly focused on, you know, relatively small movements on a day-to-day basis. It didn't bug me much last week when it was up $1 or $2, and it doesn't really make me that excited that it's down a couple dollars today.
David, this is George Ball. In the battle between the bean counters and the business people, usually one side or the other is in the ascendancy. Wouldn't you think that Lehman at this point would be marking things to a very conservative posture, where the CFO, where the outside CPAs, where the entire world wants to be sure that they can't be criticized for overly generous, for too light marking of their portfolios?
Well, I think that has to be balanced. First of all, it's possible that that's so, although, again, just from my very quick look at the disclosure this morning, I suspect that it's not so. But if you look at it this way, the company needs to raise capital, and they probably have losses. In my sense, over the last 3 quarters, they've been trying to sort of smooth things out. And now this quarter, they're a bit more forthcoming in terms of what's there. But imagine if the loss was 3 to 5 or 10 times bigger than what they're reporting today, some amount. I'm not saying that's the case, but just hypothetically so. I think if that were in case what the losses would be, if they were being conservative in the fashion that you're saying, I think the company would not announce a $15 or $30 a share loss, because I don't believe they would be able to recapitalize. But I don't know that you have to distrust the numbers, but I don't think you can give them the benefit of the doubt simply because they've announced a large loss.
All right, so they're, on the one hand, you're saying you could argue they want to be aggressive, as aggressive as they can on the marking to market, but they still have to keep people, they still have to whet some appetites, in other words, right?
Well, I think that's partly true. I mean, imagine if they'd announced a $12 a share loss this morning. We wouldn't be looking at the same stock, and it's not clear whether they would succeed in the $6 billion capital raise. So like I said last week, it'll take time for this to kind of play itself out, and it's not clear that I guess this is the second or third capital raise, but it's not clear that this will be the last one.
David, it's interesting, though, that when other of the banks took large losses, the larger the loss, the better the reaction was in the aftermarket. They puked it all out. There's nothing more there. School of thought was viewed with relief by the stocks, at least in the immediate aftermarket. And you would think that Lehman would be intensely aware of that phenomenon that's existed over the past several months at least. I mean, certainly $12 or $15 per share write-off would dramatically reprice Lehman, but better to get it all out as some of the other banks did and not have a second or a third shoe.
Well, that's true unless the all-out is too much for the company to manage in a single bite, in which case it comes in more than one bite. But there's an opportunity for Lehman here. They can come out on the conference call and say, look, we're going to provide far more transparency than we have before to assuage these doubts. They can say, look, we have $4-point-something billion that we've invested in Archstone Smith, and we wrote it down by this amount, and here's what the valuation is. And they can say, look, we have $35 billion or whatever's left. It was $35 billion last quarter, but let's say it's $30 billion or $28 because they reduced it, of commercial mortgage backs. How much of those are mezzanine loans? And how much did we write down those mezzanine loans? And how much did we handle on some of these questionable areas in SunCal? And what's going on with the Alt-A's and in the residential? And they can go through the troubled exposures in some detail and tell us what are the credit ratings of these different pieces and come out in a fully transparent way. And I think that would settle things one way or the other.
Are you long the bonds? Are you in the bonds?
No.
David, I think even before you said all that, I was going to ask you since you're not going to be on the conference call, I guess, are you?
Well, I'll listen. I don't expect to get to ask questions.
Yeah, that's what I mean. All right, so why don't you give some of the analysts that were giving you a hard time, why don't you give them some questions that you'd like to you already have. You want to know about Archstone.
Sure.
You want to know about the commercial mortgage backs.
I would. I'd like to know on those whole loans, which was $25 or so billion last quarter, I'd like to know how many of those are mezzanine loans and how many of them are senior loans and how much of a hit have they taken for these things.
And how about the land in the Central Empire in California? What do you need to know that?
It's called SunCal.
Okay, so you want someone to ask about SunCal?
Sure, and they've got about $12 billion in real estate held for sale that it says they took a $300 million gross write-down this quarter. I'd love a lot more detail on that. That strikes me as a potential problem.
And if they say those questions are not going to be answered, we deign not to speak about those, you're going to stay short, I guess.
Well, I'll judge the answer when I see it. It's too fine to calibrate that.
Although, David, you've said this in the past. You've said you don't see Lehman going the way of Bear Stearns. Is it something you still believe? Is it fair to reiterate that point?
Indeed, yes. I don't expect an uncontrolled bankruptcy in the company. I think there's a public interest in preventing that kind of a thing, and I think that the people at the Fed and the authorities would prevent that from happening. But again, I don't believe that there's any public policy interest in preserving the stake of the equity holders of Lehman Brothers.
David, Andrew Sorkin here again. In the last hour, Charlie Gasparino and I were talking about whether this company remains independent. You said it doesn't go the way of Bear, but looking at it from your short position, to the extent you believe this is a takeover candidate, and I don't know if you do, what does that do to your thinking?
Well, it's hard to say. There have been a lot of rumors, and I think Charlie Gasparino spread about 15 of them last week.
Ooh.
Some of them haven't already proven yet out to be true. Anytime you're short something, there's a possibility of a takeover. We've had that happen to us before. Sometimes it's even been painful, and other times it's even been at a discount. So it's hard to say. It would be up to a buyer to evaluate, and I would encourage any financial buyer who is looking at this to take a careful look at the exposures that they're signing on to.
So to summarize your view, it doesn't feel like what you've read so far in the release is comprehensive by any means, but you think there's a chance they could say some reassuring things to you on the call.
I think it's a question for them to come forth with much better disclosure than they've given so far. And frankly, I think this should be done, sort of in a professional way. I think it's really time to dispense with the ad hominem attacks and get down to a real analysis of what's going on with this business.